Okay, so good morning, good afternoon, ladies and gentlemen. First, great news: Arianespace lost one of its major business partner because in the recent 3 years, Arianespace was providing launch services for OneWeb group, which builds up similar low Earth orbit satellite internet like SpaceX with their Starlink. And since Arianespace was purchasing Soyuz rockets for this occasion, so now they are not able to have this platform as their medium launch vehicle, and that's why OneWeb cancelled the contract, and surprise, it went to SpaceX for launch services. So right now SpaceX launches and builds up two different satellite internet system, which is funny because many years ago when they started their business, they were also started to build up satellite internet, just it was for Iridium, and it was not for low Earth orbit, it was like geostationary orbit, so it was high latency internet. But yeah, so they are back to business, and they got huge amount of money in this case because they have to launch several hundred satellites in this contract. So they will earn some money from this. But yeah, today we will analyze the impact of such announcements. So what is happening with share prices in the launch business when some vehicle explodes during the launch, or when we are not able to deliver the cargo, or what is happening when actually the payload delivery is successful, but there are some periods until the case is not certain, and also what is happening under positive announcement. Is there any influence on share prices? So this will be in today's seminar. So first of all, I would like to talk about, or I would like to make a brief summary that what kind of models do we have to think about share prices, how share prices can be described, what kind of ideas do we have about capital markets. And in this case, we will compare the efficient market hypothesis with the crude reality. So first of all, when we have to model capital markets, usually we are always adopting some kind of models which were tested and developed for natural sciences. So we are always looking for something which is similar to something we identify in the nature, which is already described well, at least mathematically, in physics or in biology or elsewhere, usually in physics. And then we are taking some social phenomenon like asset pricing or share pricing, where we can identify quite similar behavior from statistical point of view, and then we start to adopt these kind of models. And obviously, surprise, sometimes it will not work because this is a society and this is physics, so societies can make much more troubles and can have way more erratic behavior. So that's why we have to deal with the decoupling effect from this idealistic models, and we can see that okay, there are extreme time periods. So when we have to imagine capital markets, usually we have some kind of idea. So some people says that capital markets are a club of evil people, or some gurus are actually deciding what is happening on the market and who cares about the investors. Or if we are looking on the efficient market hypothesis, in this case, all the investors are atomized, so nobody has major role on the market, so there is high homogeneity among the different investors, so it behaves like an efficient market, or completely competitive market, which is also stupid because still there are big people on the market, or big mutual funds, big hedge funds. So if we have to think about much more up-to-date models, it's like rice or rice pudding. Yes, it's in English. Rice pudding, which would describe much better what is happening there, because there are some clusters inside of it which are bigger, and there are some small individual shareholders who are also trading on the market. So it should have some kind of heterogeneity. So maybe an oligopolistic market can be a better description, where we can find some big players, but many small players as well. So when we have to talk about risk, in the case of finance, it's always about the volatility of some underlying asset price. So it's a much more like the uncertainty of pricing. Are we certain that what will be the price of this asset? Because, okay, the second class, we were talking about valuation, and in this case we were able to identify that, okay, this is the fair value of the share, but we had many simplifications in this case. We were highly optimistic about the future interest rates. We were absolutely optimistic about the exchange rate, because we were saying that it's fixed at $1 US dollar to €1. But still, we can assume that market price will fluctuate around this fair value. It's always in the focus of value-based trade, but also at the same time we can say that so volatility will be there if the market is uncertain. And what is really important in the case of risk management, that this market uncertainty about pricing is time variant, so it changes in time. It depends on the current situation. Sometimes the market is absolutely confident, so we can find low volatility, and sometimes it has absolutely no idea, and we can see high volatile periods. And also we can identify these features if we are increasing the frequency. So if we are looking on annual data, quarterly data, usually we can find so many extreme jumps back and forth, but if we are looking on high frequency data, like 1 minute or 5 minute trade activities, then we can find so many anomalous activities. That's why I brought you today two different high frequency data sets, when Astra was exploding or not exploding during launch, and also there will be another announcement. In this case, unfortunately, I was not able to get the high frequency data because it was not available in Icon, but at least hourly data we can have from trade. So yeah, and because we are operating in a highly complex society, that's why we have to hedge some of our risk, or at least we are expected to do this, or at least insurance companies, banks, mutual funds are expected to do this. So we have also some kind of derivatives. Later on we will talk about them. But we have these extreme events. And the problem is that extreme events can jump randomly. So sometimes it's just out of blue, there is a sudden jump in the share price and then nothing happens. Or sometimes there are tendencies for clustering, so there is an extreme jump and then there are further extreme jumps when market loses confidence in pricing. Sometimes it can create even a new trend in the case of the price, like what happened in the Swiss franc during the 2010s. That before 2007 it was always 0.6 something for €1, or €1 was at this exchange rate, and then during the 2010s, after some sudden shocks and extreme jumps, then it went really close to this 1-1 parity. So that's why extreme events are quite difficult to estimate, because we have only just a handful of data points to deal with them, and usually when we have this, then we have always some stories about that, how this bank or how that mutual fund or hedge fund went to default because of this occurrence of extreme events. And also, the problem is that it's hard to model. So if you are fitting some probability distribution on the data, there will be always outliers. So you can't build up efficient risk management strategies on them. There is always the illusion. There was the illusion in the 80s until the 1988 crisis hit the market in the US, and there was 25% of drop within a day on the New York Stock Exchange, and also at the same time on the futures market in Chicago. That was the end of the illusion that portfolio insurance can work, that you are trading on the spot market and also at the same time you have positions on the futures market and you can secure your position. So it was not working. Then they had the idea that, oh, buying options can secure any portfolio. Then in 1998, the long-term capital management completely failed. They were responsible for half of the option market, but they were also underestimating the increase of volatility, and yeah, so it did not end it well. It was taking $3 billion to consolidate the company, so and to avoid the global financial meltdown. And also we can see 2007, 2008 when partner risk was assumed to be measured or manageable by CDOs and other quasi-insurance-like assets against partner default. It also not ended well. So we can see that it's hard to model, but why are they appearing? So we have to talk about the actors, what kind of assumptions do we have about them, and also the structure of interactions. So what kind of market do we have? How does it structure, and what kind of consequences do we have here? So traditional approach, we have a rational agent and a random market. So this is the efficient market hypothesis since the 70s. And people were creating it not because they were dumb not to understand that market is way more complex than this, but they needed some kind of baseline model. So first you have to describe something and then you can develop it further. So yeah. And in this case, they were saying that, okay, let's assume at least in a model world that we have this perfectly informed rational actor on the market who knows everything, so it's able to collect information from the environment, and it knows the environment completely well, and has also good preferences, which is ordered, so you know what to prefer more, and it's stable, it's not changing in time. You don't have moods, you don't have trends or something like this. And also you are able to calculate in a rational way. So you can optimize. And if you watched ever the Big Bang Theory, then you know that Sheldon Cooper was something like this, and you don't want to be something like this. Or also in Good Place, there was also another series. In Good Place, there was also a guy, a moral philosopher, who tried to optimize his entire life, and that's why he was always stuck when he had to make any decision, because he was not able to do this, and he was driving everybody to crazy. So it's nice as a model, but you don't want to operate like this. Because first of all, you don't need all the information about your environment. So when I'm running in the forest as trail runner, I have to know what is in front of me, not to fall on my face. Then I have to know where I'm going ahead. So maybe if a deer is crossing the road or a boar is crossing the road or something like this, then I have to be able to see it, and also have to remember on the map, because otherwise I'm ending up in new places. But otherwise, I don't need the knowledge that what is behind the brush or what is 1 kilometer behind me. So you have to limit it. Knowledge about your environment, otherwise you will be saturated and you will be stuck in the data. Also, in the case of preferences, it's absolutely depend on the mood. So, what is happening right now? What is the current situation? We can see on the market that is the market greedy or afraid. It's always changes due to the underlying macroeconomic or social or other conditions. And rational calculation, sometimes you don't want to optimize. So if I have to decide that I would like to purchase a bread or some biscuits today, I will grab some of them. So it's not, I will not start to write up this utility curves like macroeconomics or microeconomics suggest. So there are psychological and calculation limits because we don't want to complicate everything. Let's talk about market structure. So we have actually two opposite approaches. So one is that it's like a frozen water, that the market is completely stuck in one position. It's like a lattice, and only traders can do trade with their neighbors, and they are stuck in this position, so they are not able to move out. And in this case, we can say that the market is clustered because they are not able to go around, so it's not dynamic at all. But the problem is that data travels slowly, because if we want to sell something which is in his hand and this one want to buy it, then it have to go through this way. And if this is a big market, so not just 9 actors are together, but many of them, then the processing time will be really high. So there is a reason why markets are not behaving like this, that there is a matrix of people and they can just operate with their neighbors. It would be stupid. The other, on the other end, we can see a completely random connection. So this is the randomly connected network, or Erdős-Rényi model. They were mathematicians, and also they invented some of the graph theory. And we can see that this is completely like a competitive market. So everybody is homogeneous, and not just in their size, but also in the number of their trade relations. And there is a high level of dynamism. So it's like, I would like to go to the market and I would like to buy cucumber. There are many cucumber farmers, so I can go to anyone. Mostly the cucumber will be the same, so I don't care about that which cucumber is the best. I will not bring a ruler to check that what is the length or width of this cucumber. I will purchase some completely randomly, and in this case the interactions will be highly dynamic. So nobody has preferences where to go. It's also there will be no clustering, so there will be no preferred cucumber sellers or buyers. That's just, yeah, mostly connection numbers will be the same or similar. And also small world effects can happen because far away actors can be connected as well, because they are working randomly on this market or creating connections randomly. So that's why data transfer will be really fast. And that's why we can say that, yeah, it's really similar, and it has many benefits. So if they are connecting randomly, then it doesn't matter that if one of its actors disappears, so it went to default. It will have absolutely no influence on the market structure. It will have absolutely no influence on pricing. It doesn't matter, because we cannot say that there is a big player and it went to default. because there are no big players, there are no central nodes in the system. So yeah, we would have this, but we have to think about also pricing. So what is happening with the price? So if in the past the market value of the asset behaved like this way, then what will happen in this step? Where will it go? Because somehow we have to add also probability to this game. So mostly market is really lazy, so they don't have any changes. So it's highly probable that they are doing nothing at all, or maybe some slight changes will happen, what we can see here in the past. And in extreme case, they can jump or fall to this level. So we can render some theoretical probabilities there, and this is why we can use probability distribution. So mostly when you are thinking about probability mathematics, from economic point of view or financial point of view, this is the reason why we have to deal with this. So we have an expected value, which is in finance or in financial assets, it's always 0, or really close to 0. It's usually 0.2 or something like this, 0.01 especially, which has the highest probability. And then what is important for us, that standard deviation describes actually the witness of the body of this probability distribution. So it says that let's take the distance from the expected value and weight it with its probability of appearance, and then we can describe the size. So obviously, if this body is quite narrow, then the market is absolutely sure about the pricing. So usually the market is not doing anything with the price levels. It's not changing dramatically neither in one direction. If this body is wider, then we can see that uncertainty increases. And when we will analyze high frequency trade data, we will be able to compare ordinary work days without any shocks, when the standard deviation will be smoother, and we will be able to see that what is happening when shock happens. Obviously during this trade day, then it will be wider. And yeah, extremity, which never fits well on the theoretical distribution, and they can make bad days for investors. And yeah, so we can describe it with the cheese. So some people prefers this blue cheese, which smells disgusting and can make people run away, but some people like that. In the middle there is the camembert cheese, which is still turns away some people, but most or half of the population eats it, and this is the ordinary cheese here. So that's why probability distribution matters, but also, and you have to do it in the financial sector, just you have to consider that there will be some days when it's not working at all. So there are always issues. So first of all, skewness. So sometimes share prices prefer to grow if the company is convincing enough that they are growing as well. So you have more positive growing days than negative growing days, then it creates a positive skewness there. So there is a bigger mass of data on the positive side. Or if it's like Virgin Galactic, which prefers to decrease because they are not doing anything. Okay, they were flying once with the boss, but that's also, they are still not operating on commercial level or commercial scale, then their share prices are always going down. So in this case we can see negative skewness. So actually we can see here way more negative trading days than positive one. And kurtosis actually describes the number of, or not the number, sorry, so the quantity of extreme days. So if it's the kurtosis is 3, it means that you have just the extreme days, what would happen in the case of a randomly trading market or randomly fluctuating prices. It still allows some appearance for extreme jumps, but it's absolutely boring. If it's bigger than 3, and it's always bigger than 3, then you have way more extreme jumps than it's supposed to. So the problem is that when we will analyze the real data, we will see something like this. So this is this blue line is the normal distribution, or at least I try to draw something like this. And around the mean value or expected value, we can see that it behaves or fits well to the empirical data, which is represented by this red line. So it's statistically they are close to each other. The problem is in the extremes when we can see that here at this point, so here at this point, we can see that we have this extreme return because it's really far away from the expected value. But the problem is that the probability is way lower in the normal distribution, and at the same time in reality it's way higher. So this is the fat tailness, which which has a strange name, but actually this is what make crisis situations on markets. Okay, so as a result, we cannot say that, efficient market hypothesis says that usually we have a zero-sum game. So if we are winning something, somebody loses it, and the cake is not growing. So there are no certain events. It's a fair play on the market, and we cannot say that we have such unsustainable pricing anomalies like what's happening on the market in many cases, and previous steps are not affecting the current case or state of the system. So it means that we don't have autocorrelation on pricing. So it means that we don't have trends for several weeks or several days. Just everything is determined what happened yesterday, and that's all. And after that, some random noise what we have, and that's why the market will be absolutely boring. So if this case would be in the reality, maybe some random people from the street could do all the trading activity, and we wouldn't need economists. So that's why we can be really happy that the market is way more crazier than it is expected by the previous model, because in this case we have bounded rationality. So as I mentioned already, that sometimes people are not behaving rationally, luckily, because otherwise it would be crazy. And also we have scale-free network structures on the market, which are way more oligopolistic than in the efficient market hypothesis. So this is the case here, that markets are usually behaving like an efficient market, but there are cases when they are absolutely not behaving at all. So they are complex. And complex systems are actually strange because we cannot describe all the rules in the system or all the behaviors in the system by a single model. We have so many feedback loops within this system which can be described, and some of them we can just expect. Also there can be exogenous influences in this system on the market. Let's say different news are coming, which are not company specifics, they are not market specifics, but somehow these exogenous events are have an influence on our business. Like what I started with the Soyuz business in the case of Arianespace. Suddenly a war happens, and suddenly this nicely refined business between this British company and Arianespace disappears because we don't have launch vehicle, and they have to go to their arch enemy to buy launch vehicles from SpaceX. So it's like if McDonald's would go to Burger King to buy burger meat. This is the level of craziness in this business. So, so that's why we have to study them. And from financial point of view, what is important here is we have different anomalies related to this one. So first of all, correlation of markets can be really important, and also short range and long range memories. So sometimes we can say that even we can find anomalies for longer than 20 days. So we cannot say that the market doesn't have any kind of memory. It actually has quite short run, medium run memory sometimes. And it's not related only to crisis situations. So we had an article many years ago now when we were studying 100 years of Dow Jones Industrial Index. And we were able to see that during the 70s or the 60s, Dow Jones Industrial had memory for more than 30 days, trading days. And it was not during a recession, the market was not collapsing, it just happened. So, without any implications, so we had to abandon this approach to detect extreme jumps on the market, but it was funny to see that how does it work. Also, cross-correlation. I prefer this one because in many cases you can earn money with focusing on cross-correlated assets. Like when market panic happens, in the case of in 2007 and 8, it was the banking sector. That each bank was falling because, oh my God, it's a bank, so if one bank fails in the US, then all banks all over the world will maybe fail, so that's why market confidence in pricing dropped. And there is this Hungarian company called OTP, which is a regional bank, so it's much more like a multinational company, not a Hungarian headquarters in Hungary, but that's all. And they are really conservative. I can say low tech. So they had never any deal in toxic assets. They have absolutely no idea about securitization or CDOs or other fancy words which happened during the 2000s. And so they're a really conservative bank, and mostly they are cash cow. So they are making money, doesn't matter what. And it was really funny to see that share prices were dropping from, okay, it was not funny because at the time I was also an investor, but it was interesting to see that share prices were dropping from 10,000 forints or above 10,000 forints until 3,000. And we were able to see that, okay, at 3,000 forint, you can buy it. So in the spring of 2009, I was able to see that for 3,000, if it goes down and reaches zero, then who cares what I have the investment, because it's it's the biggest bank in Hungary, so there will be a systemic banking crisis, so it doesn't matter where are my Hungarian forints. So people started to purchase, and it was really funny that only small investors appeared on the market and started to buy shares in the bank, which was completely undervalued by this cross-market correlation effect, and the fundamentals of the bank were completely the same. So it was not plagued by increasing non-performing loan ratio or anything at all. Just because, oh my God, it's a bank and it's a financial crisis, so let's sell it. So in many cases, cross-correlation can create funny things. In the case of the stock market, cross-market correlation always increases in terms of crisis situations. So if you are able to see that asset prices are tending correlating higher and higher, then you can expect something will happen. In the case of currency markets, it's completely different. So usually, at least around the euro area, currencies are highly correlating with the euro. And if there is a shock, then this correlation disappears. So even if you are looking on Hungarian forint or Czech koruna or Swiss franc or Danish krona is not good because it's fixed, but for example Swedish krona or Polish zloty, then we will see that their correlation with the euro is like 0.7, 0.8. But if some shock happens, then this disappears and then it's coming back. So again, correlation can be a good indicator of something is happening. And collective behavior during extreme market events. Actually, both of them combine. So if there is some extremity, then it will have an influence immediately on correlation. In the case of bond markets, actually it's also decoupling. So during the sovereign crisis of the Eurozone in the 2010s, so if you are looking on bond market data, we can see that only long-term bonds had some kind of correlation. It's not as strong as the stock markets or as the currencies, but still it's around 0.5, 0.4. But once country-specific risks started to emerge in the Eurozone, then this correlation disappeared. So it's really funny. And once it was stabilized by the ECB, it went back. So this is called decoupling or divergence. And it's funny because there was a guy, unfortunately I don't remember the name right now. Yeah, because this is the Bonanno article. Okay, so Bears. He's a US researcher, and he had a book published in 2002, and he was writing about this, that okay, this can happen on bond markets if the euro project is not successful, that this decoupling or divergence can happen, and 10 years later it happened, so what a success. Okay, so if you have to put everything together in the case of bounded rationality, so when I was a student, I was this tutor at the Department of Economic Psychology here. So first I started at the Marketing Management department and at this sub-branch of Economic Psychology, and later on I evolved towards finance. So that's why I have always this doubts about these efficient markets and all this mumbo jumbo what they are saying, because if we are coming from this direction, we can see that, yeah, but there are so many biases in the case of even in the identification of possible causes, which can create some results, and then that's why we can make decisions. So also reactions can be completely crazy. So sometimes market is not doing anything at all. There are no reactions. It will be funny to see when Rocket Lab announced their new launch platform and carbon fiber shaped body and a new engine and everything. The market not reacted at all. So even the share prices were dropping because there was a pessimistic mood on the market. So we will see that S&P 500 was also dropping at the same time. So maybe later on they will react on it, but these nonlinear reactions are terrible. So they are never reacting gradually. If share prices are increasing, they are much more gradual, but if there is a fall, then it's always sudden. And we can see that how imbalances are building up, or unsustainable things are building up until it starts to fall. So this one is highly deadly. Also heuristics. We are picking up some ideas. And when we have to do models, we cannot collect all the possible causes. So when we have to make models, like when we have to model currency or exchange rate models, when we have to build up these macro models which describes that, okay, if an exchange rate is changing, then maybe it's the reason because the interest environment in two countries are changing as well, so there is change in the sovereign spread. and also portfolio investments are changing, inflation in the two countries are changing, and maybe economic output is changing, central bank behavior is changing. So we can identify some major factors, but there will be still some factors which are missing out. So usually in these macro models, we have an R square like 0.1 or 0.3 in many cases. And you know that in marketing, with this cross-sectional analysis, people always have this 0.8, 0.9 R squares because they have to describe everything in their model. In macro modeling, we don't have this luxury. So once I was asking a guy from the US Fed, he had this, glasses, bald, so everything was perfect to have high impact factor in macro modeling. And then he was telling it to us that no, macro models are not about R squares, it's much more like about reliability, and if you can use it, if you have at least significant results with them, and the diagnostics of the models are good, then you are really happy. So you don't want to identify all the possible causes, because it would make the model completely crazy and you cannot use it for predictions. So yeah, but also we have an uncertain environment, obviously, so that's why we have expectations. And as a result, we have this fundamental value here, but market value can fluctuate around this. So this is what Mr. Costolani, who was a famous investor during the during the entire last century, was saying that fundamental value is when you are walking with the dog. So the owner of the dog is the fundamental value, and the dog is rounding forward and backward like a market value. So we can at least assume some fluctuation, which is good for the investor, because if you can say that, okay, the fundamental value analysis says with all the possible sensitivity analysis with it, that still market value is some incoming call from Budapest, maybe they would like to sell me some insurance or medicine. Yeah, sometimes they are calling me and they would like to sell me some vitamin. And you know that they have this questionnaire, and I tried each possible scenario. So I'm smoking all the day, I'm not smoking at all, but at the end of the day they want to sell it to me because they want to keep me healthy. Now it's handy. So if you can see that by doing or really robust fundamental value analysis, and the market value is still lower than this fundamental value, then you have to buy it. So this is the Warren Buffett investment rule, that you have to buy when it's cheap, and you have to understand the company. So Warren Buffett was completely left out from the entire internet bubble during the 90s, because he was saying that I would like to purchase only into company what I can understand. Coca-Cola, it's simple company. They have a well-defined brand. They are selling sugar water with some flavoring in it. It's also really simple, but it's supported by intellectual property rights that it's hard to steal, and after that it's just a cash cow. So if the market value drops below their cash making capability, then you have to buy it. If it goes up, then you can sell some of them. So it's a really long-term approach. And obviously, it will have way higher volatility than the usual or other investment techniques. Okay, so nonlinear dynamic, this is what happens. So causes are building up, and suddenly there will be a reaction in pricing. And last thing, scale-free complex networks. So how can we think about them? Maybe the simplest thing is, let's think about the IT sector in the 90s, when many new companies were emerging. Then the 2001 crisis came. Many of them went to default because they were completely useless before of that, and they were never able to make money. So yeah, and after this, cleansing on the market, suddenly some new hubs emerge. So we can see that since then Google started to emerge. Okay, we had Microsoft since the beginning of time, so it's also still there with us. Also we have Facebook, we have Netflix, which was emerging as well. So we are able to find some key players on the market. And these key players are always doing some mergers and acquisitions. So they are purchasing some startups, they are purchasing some companies which can contribute to their success in the future, or maybe they just can open into new markets or segments. And we can see that in this case you have much more higher preferential connectivity. Maybe if you are not focusing on their acquisition policies, but still they are connected to so many companies because they are providing services to these companies. And what would happen if Google would disappear from one day to another day? Obviously it would create a huge mess on the market because all these connections, business relations would disappear at the same time. So this is the same what happened in the case of Lehman Brothers, that they were really important in risk management until their lifespan, and once they disappeared in September of 2008, suddenly many banks realized that now they are not able to hedge their risk anymore because their partner was Lehman Brothers, and now it disappeared, or they were purchasing some nice bonds which were issued by the Lehman Brothers, and also they were in terrible situations. So yeah, if these oligopolistic actors are disappearing, then it can have its consequence. And this is what can be described as carefree complex network. It's carefree because their structure is not changing in time, so we have always some preferential actors there, and also it's not changing if we start to add further actors. So if we will add newer or more and more traders or banks to this market, still the previous nodes will be there. Or maybe one is disappearing, but a new one will reappear. And yeah, and it's inhomogeneous. So I mentioned already that we have hubs, but the rest of the market is still a competitive market. So it's connecting randomly. It doesn't connect to anything, but it prefers to work towards the main hubs. And if something is disappearing, then we have a phase transition. It means that the market, if we are starting to kill the main hubs, so let's say we are destroying the monopolies. Let's say we are splitting Facebook to sub-companies, and we are forcing it to the market, or also we are destroying the monopoly of Amazon or Google in the market. What will happen that, okay, we are rearranging the market into competitive state. So it will be this other much more competitive market structure, a random network, but it will rearrange itself sooner or later. So you cannot say that once you split the monopolies up, then they will remain the same. No, the market will start to put itself together or to recover into this oligopolistic state. Yeah. Okay, I talked about this one. So let's say about extreme events. Yeah, it's a nice illustration that in 2009 we had this ordinary Christmas weather with storms everywhere in the country. Were supposed to be snow, maybe. So we had summer weather in Christmas. And if we have to define extreme events, because I mentioned them already so many times, then we have this definition of vulnerability. We have the definition of event. So something is happening within limited time and space, and we can say that we can delegate some kind of probability to this one. And it will be extreme because it's low probable and it has a significant impact. So it's great consequence can be identified. So it's somewhere here on the tails of the distribution. And obviously it will have some statistical properties. So if we are fitting some probability distribution, then it will be on the tails. And that's why power law distributions with heavy tails became really popular during the 2000s, once people were able to calculate with them. Because first heavy tail distributions were published in the 30s, 1930s. So it's not completely new thing, just you need models and computers to use them for calculations. And the dynamic properties are that they need complex systems. So they can appear sometimes in a random network as well, but now to have a really fancy extreme events, you need complex systems. And this carefree system, what I described before. This carefree system will generate extreme events much more. So it's extreme events in a carefree system or complex system will be a feature, not a bug, because it will generate it once suddenly we are removing one key player from this market. So that's why data is not fitting well to the normal distribution, and we will see how, because we have data sets. So and yeah, from statistic point of view, we will have problems in the case of the probability distribution. We will have problems in the case of the volatility. So sometimes volatility will jump into the sky, and also sometimes we have also problem with correlation among the assets on the market. Okay, this is autocorrelation. How does it look like? So we can see that the market follows some trend. Also, this is heteroscedasticity. So sometimes volatility is low, sometimes it's going up, and yeah, this is how we can describe it. So it means that current volatility depends on past volatilities and some noise, but mostly it's yesterday. It's usually 1 day backwards what you can fit. So this was my PhD thesis. Part of my PhD thesis was when I was working with gauge models, and usually only for 1 day backwards you are using volatility, otherwise it's not preferred. Only I was able to find some African free floating currencies when 2 days backwards was significant, otherwise it's not working at all. And obviously global market had many imbalances, so we can see that correlations between markets was increasing significantly since the 80s. So as markets became bigger, as they became more and more globalized, then their common movement started to increase. And nowadays we can see that if we want to build a well-diversified portfolio, you need some assets which has a zero or negative correlation with the rest of the market. But in the case of, for example, exchange rates, it's really hard to find. So only some African currencies, free-floating currencies, have this zero correlation, or cryptocurrencies have also zero correlation. And that's all other currencies have some kind of correlation, and it changes also in time. So it's nearly impossible to build up a well-diversified portfolio in real life. Or you can build it up, just in this case you have to rearrange the portfolio so much that transactional costs will increase. And volatility diffusion, we can see nowadays that if some global shock is happening on currency markets, capital markets, then it goes through the entire globe immediately. So yeah, and fundamental and market value can diverge, and we have market bubbles everywhere. Just unfortunately we are not able to identify, so there is no market bubble detector. Maybe if we are using a lot of resources to identify the fair value or fundamental value for a company, then we can have assumptions that maybe there is a bubble, but it's not exact science that we are pointing on, and it will work. So we can have many conclusions here, but let's focus on real market data. So first of all, we will see what is happening when things are going sideways.